I will apologize in advance for doing this in English. I can do this in many languages, but unfortunately Spanish is not one of them, so you're going to have to bear with me in the English presentation. I just wanted to thank so much for the opportunity to be here today. It's my first time in Colombia, and having met several investors, the trends that we're seeing in this market mirror so much what I've seen in kind of my 20-year career, which I've spent predominantly at in Toronto, in Canada, starting at Scotiabank's capital markets trade floor, and specifically in fixed income. And having come here now and having spent a bit of time with clients and investors in this market, we're seeing so many of those trends being repeated today. And I'm very thankful for the opportunity to talk to you about the evolution that we've seen in other markets globally, and consider how those might come into the LATAM region and how those might come into Colombia specifically. So today I wanted to share a bit more about FTSE Russell, who we are, what benchmarking actually means for the industry, for investments, and how it fits within the ecosystem of being able to manage and track your investments and grow that investment profile for your clients and for yourselves. So to really, I think, understand the role that benchmarks can play in the investment ecosystem, it's important to kind of consider the genesis of where this came from, and how they've evolved through the culture and became part of what is a very natural investment profile for any fund manager, mutual fund, ETF, or even retail investor today. Most indexes, specifically in fixed income, grew out of capital markets research desks and were meant to be a measurement of a market opportunity set for any kind of investor. And that continues to be a major role that benchmarks still play today. However, as instruments in general became a lot more sophisticated, markets became a lot more sophisticated. It's not just government securities anymore. There's a plethora of kind of corporate debt that's being issued, different capacities, different underlying, driving that debt. Indexes have evolved to become not just the measure of the market, but also a way to be able to represent an investment theme, to be able to represent a much more sophisticated way of looking at what is in the market, how you measure that market, and how you invest for those markets. Also, as money is starting to move through a global system, and money is starting to come into regions where people are not necessarily domestically focused and have a deep local knowledge, these benchmarks and these ways of measuring the market are becoming a way to be able to research what is happening elsewhere in the world, how does that compare to what you know in your own metric, and how do you invest for that type of a profile. The other kind of development is that as investors and really managers have become more sophisticated, there's a lot of product that's now being based on these benchmarks. We heard Wes talk about the ETF trends and how those ETFs are being packaged to allow investment profiles into the investor hands. A lot of that is being underlined by benchmarks. A lot of those benchmarks FTSE Russell provides. And through that comes the need and desire for kind of transparency and consistency for achieving those market returns, both from measurement and managing of the risk, but also through tracking performance. And when we talk to mutual funds, to ETFs, to asset managers, to pension fund, to allocators, to sponsors, et cetera, the baseline benchmark is what provides not just the ability to say, this is what I've been able to return to my unit holders, but allows the managers a much more sophisticated tool to say, this is the risk that I'm taking on, this is how I'm managing against different markets, and this is how I'm going to allocate my assets for the future, how I'm going to research what I expect to be happening in the investment volatile market, and then to show on the flip side of that the performance of your fund versus something else that has happened in the market. So effectively that market beta. That ecosystem has been something that a lot of index providers have been building up over time. So the ability to cover multiple markets, ability to cover local depth and local presence of those markets, as well as global opportunity sets for investors in equities, in fixed income, increasingly in alternative assets, and then supporting that kind of multi-asset coverage with deep data sets to allow investors to make decisions over time and analytics in order to be able to navigate those decisions and convert market information into investment advice. And FTSE Russell today is the leading provider of all of that information. In fact, one of the kind of metrics by which index providers generally look at themselves is by the amount of assets globally that's tracking our benchmarks. And here it's shown that number is about 15 trillion globally. That number is probably more like over 16 trillion today. Makes us the leading provider in the world about assets under management that are tracking one of the benchmarks that we provide. This whole multi-asset kind of composite is one of the trends where we see the world headed, and where we're able to best serve that diverse client need that we see developing. Oh, sorry. So this is a bit of a show of the ecosystem that transpires in order to be able to drive the assets. So clients are becoming a lot more sophisticated as technology is allowing them to do that, as they're looking to meet their own client needs. And what that means is that we, as an index provider, need to provide that same degree of sophistication of the tools that they need in order to be able to ready to meet those client trends. What that means in practicality is that what indexes allow you to do is to look at a complete picture of an investment choice set that's available to people throughout the globe in both local markets and local ones, and also in equities, fixed income, and beyond. So, through the kind of lens of the indexes that we provide, those will range the gamut between kind of broad-based market cap equity exposures through FTSE World or FTSE Emerging Indexes, all the way to fixed income, which is our World Government Bond Index, and local market exposures like FTSE PIP Colombia, for example, all the way to kind of the thematic indexes that are ESG screened, climate risk profiled, have different capitalization schemas, have laddering or target date, and fit within different provision of different client needs and client demands. What I wanted to talk about is that this evolution in both indexing and investments is happening against very much a backdrop of kind of market consolidations in our industry. So this is kind of a highlighted chart of all of the acquisitions that have happened in the index market data kind of space over the course of the last 5-ish years. So, one of the top ones that you see there is the London Stock Exchange, which is, of course, who owns FTSE Russell and the group of companies of which we're a part of. But there's been multiple acquisitions within our space on, as index providers strive to become a truly multi-asset global provider. They're acquiring things like equity house providers, fixed income providers, a notable acquisition of Bloomberg Barclays, the Barclays indexes, which were Lehman Barclays, now became Bloomberg, and et cetera. And that trend is continuing, and we're seeing that trend continue. And a lot of what's driving that is the divesting of, especially in fixed income, out of investment banks, largely driven by regulatory regimes, but also a consolidation within specific houses that are able to service clients end to end. And hopefully our clients are seeing the benefit of that across the board. So industry trends. So as we find ourselves much more in the middle of kind of global markets and talking to global investors throughout, investors that are more and more having to deal with the challenge of markets that are facing a low yield environment, increasing and resumed volatility, search for yield, trade war pressures, low inflation expectations and low growth expectations. Investing in that type of world becomes an increasing challenge. Regulatory pressure that's driving this on the back end, clients that are continuously looking for how they invest in that space, how they research, and how they take advantage of the trends that they're seeing. Some themes continue to permeate no matter where we are in the globe and no matter who we're talking to, whether it's kind of very sophisticated providers like ETF providers and large-scale asset managers to much more emerging markets and guys that are managing money in local markets. So and we'll touch on all of these as I kind of go, but a big theme, and one that was touched on earlier this morning, is certainly investing for climate and investing for ESG. And I'll share with you kind of what we've seen in that trend and how we've looked to address some of that. The other piece is a continued demand for transparency and systematic way to be able to approach the market. So, and this is coming from regulators as well as asset managers, and increasingly from clients who are much more knowledgeable about their portfolios. It's millennials that are investing, they know what they're investing, and they want to see that transparency both from the asset manager and from their investment. And a lot of what we provide allows for that to occur through the system. Another big trend is a convergence towards multi-asset. So an ability to look at your book cohesively. So look at all, not I have some fixed income here, I have some alternatives there, and I have some equity exposures over here, but how do I measure my risk across the board? How do I structure my portfolio to be able to pivot between my fixed income and equity allocations as the markets change, as yields change, as return and inflation expectations change, and the research that we provide to support those asset allocation decisions. And certainly a big driver is being the flow of capital from global investors into emerging markets, facilitated by the search for yield, as global yields, and specifically in fixed income, global sovereign yields, have taken quite a bit of a pressure. Global investors have been chasing assets into emerging markets. What that's meant is the need for coverage within the emerging market space to really open up. We fully appreciate that a lot of the local domestic non-hard currency emerging market continues to be totally underrepresented in global portfolios and in indexes and is not systematically covered. But as global investors start looking more and more into this space, and that's a trend that we see continuing, and as the space becomes much more of a significant asset category, the presence of benchmarks that are tracking this, that are allowing global investors to look at these markets, measure these markets, and invest in this market, bringing with them a lot of flow of capital to then support further development, becomes quite important and becomes a trend that we see throughout the world today. So just diving into this a little bit more, and we'll start with the markets a little bit. So, emerging market issuance, from what we've seen, has been driven not just by the search of global yield, but also on the issuance side. There's been much better market socioeconomic and macro policies that have supported the relaxation of these markets, allowing investors to continue to invest. And there's been a relaxation of, obviously, capital controls, a trend that we are hopefully continuing to see throughout the emerging market ecosystem. And in EM specifically, an interesting trend is through 09-14, so kind of a post-crisis era, we've seen a tripling, about $1.5 trillion worth of debt that was issued, which is triple what was issued in the 5-year preceding that period. And certainly these have been snapped up globally. There's been a large public demand of seeing that. With that kind of issuance, EM within the global market ecosystem becomes much more of a substantial asset class, an asset class that's attracting that kind of global investment, attracting that global money, and that's happening in both sovereign and an inflation-linked fund. Coupled with kind of a synchronized slowdown in global growth and a kind of a push on inflation expectations, with China, of course, being the notable exception, although still a tapering of that given the current rhetoric on trade wars. What that's meant is that there's been kind of a driver on yield convergence in the emerging markets, more towards G7 countries, and specifically in US Treasuries. So as we've seen the compression of those yield spreads, emerging market portfolios continue to deliver most of the growth. And what this chart shows is that most of the growth that people have been seeing and investors have been seeing globally is coming from EM, and LATAM kind of tends to lead that pack. This is a last 5-year kind of period in relative performance. So in the LATAM, what's interesting is that this trend is true both in local currency exposure as well as in US dollar terms. And within the LATAM region specifically, Brazil tends to lead the region, but Colombia outperforms relatively to other places. And that's, again, a trend that continues to be seen both in local currency as well as in US dollar terms. So it's, from that perspective, it's no surprise that there's been continued interest in money trying to come into the LATAM region and trying to represent this. Furthermore, the duration profile, so the kind of risk extension profile of the EM region is much shorter than what you see globally in other places, whose durations have continued to extend over the last decade. And that continues to explain kind of the lower volatility of those returns. And you can see that emerging market government debt has one of the better risk-return profiles globally in the space. So what does that mean? What that's meant is that global investors have continued to have interest and an outpouring of money that has been interested in being invested in this market. What that's meant for index providers is the demand and the desire to continue to increase index coverage, because that is how global investors tend to think about the region, and how local investors should be thinking about their place within that global ecosystem, and how you think about investing for the future in that space. And our, our profiling of this market has expanded and enhanced quite significantly over the last place, and provided comprehensive coverage of this, both in hard currency through kind of our LATAM corporate and LATAM government indexes, but also through our partnership with PIP, who provide local currency benchmarks in both sovereign inflation-linked as well as in corporate markets. And that has continued to open up the market. And what that's meant, as I've been saying, is that that allows for the money to flow through the ecosystem, allows investors to come in, allows for local investors to track and measure their performance and their delivery through, and really allows for fund flows through the system today. And we expect this very much to continue. We see a lot of interest from product issuers and investors in this space, and we expect to continue broadening our coverage and the sophistication of the products that are being offered here today. Okay. The other big trend that we've been seeing, and certainly one that's been talked about here, is ESG. I think I'm not going to go through, whether or not climate is a real concern or not. I firmly believe that there's a change. Even through my kind of lifetime, I've seen a change in sea levels and weather patterns and volatilities, etc. But the way we've been looking at climate, and certainly investors are considering climate and sustainability in their funds, in their portfolios, and this is a conversation that's had and that's led with increasingly as we go through the world. Certainly Europe has kind of the most penetration of this, and the European funds have taken a huge stance on this. Canada, which is where I spend and where I'm based, has spent the pension funds who direct the most source of asset flow through the system have taken a huge stand to say, this is how we want to invest and this is how we plan to invest. But we hear this conversation happening everywhere. And we certainly think this is a conversation that should be happening everywhere, and one that should be in the minds of investors globally. So there's many different ESG themes, and we offer many different ESG products. We offer, the E, S, and G scores, ability to measure companies and individual risk. What I wanted to talk to you about today is something that's been quite innovative and a way to take a look at sovereign exposures to climate risk, so ability to measure governments and their readiness for climate exposures. Because the reality is the majority of the funding that happens for climate, especially in areas where there is physical climate risk exposure, so from government or countries that have exposure to sea levels or changing volatility patterns in weather, or that are financing kind of the cleanup, like oil spills or mining, etc., that have a lot of that kind of exposure, have to start thinking about how they're positioned for that climate risk, how much they're going to have to spend in order to be able to be ready for that risk when that comes. But also how they position themselves globally when investors around the world start financing and moving funds away from countries that score poorly on this kind of piece. So, a very real example is we're having a live conversation with the Canadian oil and gas industry that's very much concerned about the flow of capital that's stagnating from being invested there. And Canada is very much a resource extraction economy. There's a large sector of the economy that's dependent on the oil and gas industry. The lack of funding into that by people not wanting to buy bond issuance, by global green portfolios not accepting those securities, results in things like, is associated with a lack of funding in that industry's unemployment impacts the entirety of the Canadian economy. And so the way that we've split up this measurement is into something called transition risk, which concerns itself with readiness for future carbon emissions and really carbon alignment and climate alignment at a 2-degree climate change. Physical risk, so this is very much those economies that are dependent or exposed to the physical allocations. And also resilience index. So how much are you investing? How resilient are you to be able to, how many reserves do you have to be able to take these pillars on? So there's a very sophisticated quantitative model that scores these across a multitude of parameters. It is a recent acquisition by FTSE Russell of a company called Beyond Ratings, based out of Paris, have a very kind of quantitative model, but it's been distilled into these very 3 notable things of how investors and issuers, if you will, associate themselves and try to place themselves in investor portfolios. And so we look at governments, so largest issuers of debt globally are sovereigns, and we apply these criteria to this government risk, and we score all of the countries that are in the WGBI. WGBI is the World Government Bond Index. It's a benchmark that's provided by FTSE Russell, and it is the largest benchmark which is tracked by investors following sovereign debt exposures, right? So we score these towards climate risk. We take this kind of quantitative approach, very transparent, and we tilt the weights of those countries in or out of those WGBI exposures. So this is just a kind of a, example of how that changes. But for example, the US, which is the largest kind of global developed market in the world, representative of about 38% of the WGBI, is underweighted by 3% in the climate version of that index. And you can imagine that, I believe last count was something like $3 trillion tracking on the WGBI. Should all of those money, or a large proportion of those money, move out of WGBI towards this climate tilted version, how much of an underselling there will be for US debt on a 3% underweight, yeah? So, and certain countries are overweighted, of course. But interestingly, and this is again touches on the theme that was talked about earlier, which is no longer the sophistication of how these benchmarks are put together and your ability to express a view on climate and on future sustainability of this. No longer do investors have to sacrifice returns. And when we've looked at this with respect to WGBI, over the last, so this is 2002, so about 8-year time horizon, the climate portion of the government exposure actually outperforms the underlying, but the risk profile remains largely the same given the tilt methodology applied. So, what this does is allows investors to express a view on climate through a very transparent, kind of easy to tell vehicle through the benchmark, through the index, allows managers to express that as a story to be able to tell their clients, but also to deliver not just on feeling good that you are supporting the evolution of climate and investing for that future, but also you're performing no less and in fact even better than the underlying. So there's no sacrifice of performance in that space. So, this is being very positively received. We expect to see a lot more of this type of stuff coming. And, from our perspective, this looks at governments and sovereign debt. So this is not just a corporate story. It's not just a kind of a way to look at corporations, but more meaningfully, this is a way to look at the largest issuance of debt globally, which is coming from sovereigns around the world. Yeah. I wanted to touch a little bit of this. So I talked earlier about transparency and the desire for transparency. And, as indexes baselining most product in the world, and there's trillions of dollars tracking these benchmarks, what's being demanded, initially through regulatory regimes, so things like IOSCO and EU BMR, which is basically regulatory stuff that's come off on the back of LIBOR, but also by investors themselves and by people who are providing assets that are tracking the indexes, is this concept of transparency. So how do I know what my assets will look like? How do I know how I'm investing? And how do I know what decisions will be taken in these benchmarks, especially through the rise of passive, as fees compressed and passive investing is becoming more and more prevalent, in the indexing space, in the fixed income space. That demand and those drivers become critical. And there's many ways in which we address those, and many ways in which we, as an industry, are providing that. So, you heard earlier about this concept of fees and letting the investors know what the fees are. We make methodologies public. We talk about previews. We talk about how these things are going to be happening. But more recently, as capital is shifting around the world and portfolios are becoming global in nature, we have introduced this concept of a country classification profile. So this is a framework that allows investors who are used to looking at this from an equity perspective that does, developed, emerging, frontier, etc. In fixed income, no such concept. And especially important and critical today in emerging markets and through the lens of China. So, the potential inclusion of China out of an emerging market and into potentially developed market global benchmarks is probably the largest structural change in the investment profile that I'm likely to see in my career. And it's one that's watched incredibly by investors around the world. China, in an uncapped version, represents about 50% of emerging market portfolios. And if it were to move into DM markets, it has a huge implication for investors and has a huge implication for investment themes. So what we introduced is this concept of a market accessibility level, which is a way to be able to track markets around the world and measure them, whether they belong in things like WGBI, which is a liquid global sovereign investor pool risk profile, whether they're truly emerging markets, and how those markets will move in and out of those profiles. So, there's a series of criteria that have been developed to do that. And there's an annual cycle and an annual review cycle. But what's been really interesting for investors is that we publish something called a watch list. So we make publicly available after this kind of annual review cycle what countries could potentially be excluded going forward or put in going forward. And on the back of that, skips through some of these technical details, but you can see that there's kind of a technical detail there that says, Malaysia, Indonesia are on the watch list, China likely to be on the watch list for upgrades, etc. What this has allowed us to do is to engage with regulators and stakeholders across the globe to be able to facilitate either reform or the way people are looking at markets, and also to provide investors with the tools to be well positioned for how capital is expected to flow in the future through these benchmarks, through these products, and through their portfolios. And last but not least in the trend space is this concept of multi-asset and where we see this heading. Now, this is still, I would say, in its infancy, and not a lot of providers out there are positioned to be able to take advantage of this or be able to deliver on this. But the idea is, and we see this trend specifically in large asset owners, so pension fund schemas, global sovereign funds, and really long-term investors, so insurance, pensions, that are trying to deliver a particular investment profile and a particular fund profile for their users. So typically, the way we had seen portfolios kind of structured is to say, you investor have this kind of a profile classification, put some money in fixed income here, put some money in equity there, and all you're looking at is potential for return. But there's no way, and a lot of times the underliers are being provided by different providers or being packaged by different packagers. And there's no way for the investor nor for the provider to really meaningfully be able to measure the underlying risk of such a portfolio, nor to then take those same parameters that went into the risk management, take them through the investment life cycle, be able to asset allocate and pivot through that allocation as you go through the life of the investment, and then come out the other side and measure that in performance measurement across the entire portfolio, or to meaningfully allocate and pivot between the equity fixed income allocations or alternatives that may be there. So the development, number one, the consolidation trend of being able to have indexes on both sides of the spectrum offered through the same provider so that you can build a link between the equity instruments and fixed income instruments is spurring the ability to deliver on this. So that's number one. Number two, technology is facilitating the ability to be able to analyze these assets against each other, and the development of that technology both on the management side as well as on the investment side, to deliver those together in cohesive kind of glide path portfolios, is there. And so we see this trend really growing, and we see this type of way of investment permeating itself through the investment kind of cycle. So sitting in asset allocation as you're making those decisions, through the portfolio construction, through risk allocation and being able to assess, this is my total portfolio exposure, what's my country risk? Not just, this is my fixed income and this is my equity, but how am I sitting across my total portfolio? What's my credit exposure to this particular issuer across my entire portfolio in equities, in fixed income? And then depending on from the investor and from these type of glide paths, pension schemas, if I'm at a certain age and I have a certain way of, certain horizon for investing, and then drawing down on that over a certain period of time, how do I position myself between, 80-20, 70-30, et cetera? What's my risk profile to be able to do that? And then measuring the performance, again, on total portfolio fund. How did this sector perform for me? How did this issuer perform for me across the board? So this is still in its infancy across the world. More and more providers are pushing for solution on this, and more we see asset owners demanding this of index providers and demanding this from asset managers to be able to deliver them a total portfolio solution. So this is one to watch, we think, quite robustly. And then I thought I would close, I kind of started to say that I started my career in capital markets in Canada. So I was on the Scotiabank's capital markets fixed income floor, where our business in Canada really started. And through my 20-year career, I have seen the evolution of Canadian investment, and I have seen the evolution of the products that are supporting that investment. And coming into LATAM, and doing a bit of research on what's happening here and in Colombia, I was struck by the parallel of how much the investment profile in this region today looks like what we had seen in Canada over time. And I thought it just might be interesting for you to see what's happened to those asset allocations as we've gone through kind of the last investment cycle, and what potentially we could expect elsewhere. So this is done through the lens of asset owners. That's the easiest way to kind of try to look at capital allocations in a region. So this particular slide looks at CPPIB. So CPPIB is Canada Pension Plan Investment Board. Canada Pension Plan manages the mandated federal pension allocations for all Canadians. So this is like the sovereign pension fund. It's the largest fund, certainly in Canada, and it fits within the top 10 globally, right? So their investment profile might be slightly different than what you'll see elsewhere, but we do see this trend permeating through the country, and I'll show that to you as well. So in kind of 20-ish years ago, what you see is a pension allocation. I can't point, but this is in 2000. The first bar there, what you see is almost 100% domestic fixed income. And in 2000, the majority, so today Canada runs about a 70-30 sovereign corporate allocation. In 2000 and predating 2000, it was maybe closer to 80-20. But that kind of 70-30 split in local, domestic, government versus corporate split, right? So what you're seeing predominantly led by government, over 90%, if not 100%, fully invested in fixed income. And the chart on the left shows a kind of crossbar. The gray line is foreign assets, and the kind of burgundy line decreasing are Canadian assets, right? So fixed income, fully domestically allocated, right? And what you see going through are a couple of things. So number one, in 2005, right before the crisis, Canada relaxed a foreign ownership cap. So pension funds couldn't hold more than 25-30% of non-Canadian assets. So that was relaxed and eliminated. That was relaxed over time and eliminated in 2005, which spurred investment outside. Number two, as the size of the fund became larger and larger over time, they kind of outgrew just a local domestic market allocation. So, today Canada represents sub 5% of global equity exposure, right, by market cap, just generally. So some would argue that this fund at today sitting at sub 20% is still too high versus where they should be. And what you've seen over time is this diversification out of just fixed income. Certainly yields have been going down. People have been looking for returns. Fixed income is playing a supportive role and a very important role in the portfolio. But certainly there's been a move towards equity allocations, and the green represents the alternative asset side. And you'll see that this trend is true for most funds that we looked at for Canada. So Caisse de Dépôt manages public pensions in Montreal, in Quebec. Ontario Teachers manages all of the teacher pensions. So same kind of idea. They all start from a different base, but over time increase in out of just fixed income, peppering their portfolio with equities and alternatives, and going out of domestic allocations into non-domestic exposures. And, this is LATAM as we see it today. And having met a lot of kind of investors over the last couple of days, the story that we hear is the same. We're mostly domestic, and we're mostly in domestic fixed income. So it's just an interesting parallel of where we might expect to see this head in the future as markets open up. Obviously, in the EM region, the story is slightly different because yields here are higher than what you'd see in the rest of the world. But we certainly see the demand for diversification. And, we'd hope to see, as market relaxes and as capital controls support this, an ability to diversify and grow the equity exposures and grow the global allocations. And with that, I will wrap up. So thank you guys very, very much. I won't ask for any questions because I was warned by the prior speaker, but we are, myself and the team are around here for the day, so I'd be more than happy to chat or connect with any of you. Thank you.